effect of transactions upon the accounting equation. Assets is equal to liability plus owner's equity. Below is the data of Mr. Noman and Company for the month of July 2019. July 1st, Salman started his business with cash 1,50,000 rupees. July 5th, purchased furniture on account rupees 4,000. July 6th, purchased goods for cash 15,000 rupees. July 12th, sold goods for cash 15,000 rupees costing rupees 11,000. July 19th, sold goods to Rashid on credit basis for 8,000 rupees. He sold goods on cash. July 30th, paid salaries for the month of July rupees 4,000. Required, show the effect of the following transactions upon the accounting equation for the month of July 2019. Let us solve the problem. July 19, transactions, asset, liability, owner's equity. July 5, transaction. Salman started his business with cash 1,50,000. So this will increase asset by 1,50,000 and it will increase owner's equity by 1,50,000. July 6, purchased goods for cash 15,000 rupees. This will reduce the asset 15,000 cash and it will reduce also the owner's equity as the purchase of goods has been made. July 12, sold goods for cash rupees 15,000 costing 11,000. This will increase the asset cash and it will increase the owner's equity also by 15,000 cash. July 19, sold goods to Rashid on credit basis for rupees 8,000. He sold goods on cost and this will increase the asset as we are receiving accounts receivable on the asset side and it will increase the owner's equity also by that amount 8,000 rupees. July 30, paid salaries for the month of July rupees 4,000. This will reduce the cash, so on the asset side minus 4,000 and it will reduce the owner's equity also by 4,000 rupees. Now if we total all the assets, it is 1,54,000. If we total all the owner's equity, it is 1,54,000 and there is no liability. Accounting equation, assets is equal to liabilities plus owner's equity. So it is 1,54,000 assets is equal to liability plus ownership also equal to the same amount 1,54,000. Let us discuss some notes on this accounting equation. What is the accounting equation? The accounting equation is a basic principle of accounting and a fundamental element of the balance sheet. The equation is as follows. Assets is equal to liabilities plus shareholders' equity. This equation sets the foundation of double entry accounting and highlights the structure of the balance sheet. Double entry accounting is a system where every transaction affects both sides of the accounting equation. For every change to an asset account, there must be an equal change to the related liability or shareholders' equity account. It is important to keep the accounting equation in mind when performing journal entries. The balance sheet is broken down into three major sections and their various underlying items: assets, liabilities, and shareholders' equity. Total assets, current assets plus non-current assets. Total liabilities, current liabilities plus non-current liabilities. Total shareholders' equity, share capital plus retained earnings. Below are some examples of items that fall under each section. Assets is equal to cash, accounts receivable, inventory, equipment, etc. Liabilities, accounts payable, short-term borrowings, long-term debt. Shareholders' equity, share capital, retained earnings. The accounting equation shows the relationship between these three items. The accounting equation can also be rearranged into the following form. Shareholders' equity is equal to assets minus liabilities. In this form, it is easier to highlight the relationship between shareholders' equity and the debt, that is liabilities. As you can see, shareholders' equity is the remainder after liabilities have been subtracted from assets. This is because creditors, parties that lend money, have the first claim to a company's assets. For example, if a company becomes bankrupt, its assets are sold and these funds are used to settle debts first. Only after debts are settled are shareholders entitled to any of the company's assets to attempt to recover their investments. Regardless of how the accounting equation is represented, it is important to remember that the equation must always be balanced. Examples of the accounting equation. For every transaction, both sides of this equation must have an equal net effect. Below are some examples of transactions and how they affect accounting equation. 1. Purchasing a machine with cash. Company XYZ wishes to purchase a $500 machine using only cash. This transaction would result in a debit to equipment $500 and credit to cash $500. The net effect on the accounting equation would be as follows. Assets plus 500, assets minus 500, no liabilities, no shareholders' equity. This transaction affects only the assets of the equation. Therefore, there is no corresponding effect in liabilities or shareholders' equity on the right side of the equation. Example 2. Purchasing a machine with cash and credit. Company XYZ wishes to purchase a $500 machine, but it only has $250 of cash in its holdings. The company is allowed to purchase this machine with an initial payment of $250, but it owes the manufacturer the remaining amount. It will result in a debit to equipment $500, a credit to account payable $250, and a credit to cash $250. The net effect on the accounting equation would be as follows. Assets plus 500, assets minus 250 for the cash we paid to the supplier, and the liabilities 250 because we are due to him $250, and shareholders equity 0. This transaction affects both sides of the accounting equation. Both the left and right sides of the equation increase by $250.